notes that you can look at. I'm going to go pretty quick. I know most of the room, if you missed something, didn't get something, let me know and I can pass it to you. But I know most of the room have heard me talk and give my little self-employment, how your tax and all that good stuff talk before. So I don't want to bore you too much, but mostly I want to focus on the new stuff that's happened. Okay. The OB3, the one big, beautiful bill that's going to impact a lot of us. Okay. It'd be very helpful, actually. But just to kind of lead things off about the self-employment activity, you guys have your own business, right? Whether you think you do or not, you do. That information is going to be reported typically initially on a Schedule C, a sole proprietorship. Yes, there's situations where you can create an LLC and make an S corp election. We'll talk about that in a second. But people ask me all the time, what can you write off? What kind of write off? You can write off expenses related to the production of the income. So if you buy fancy business cards, yes, absolutely, you can write that off. If you got a shirt with your logo on it, absolutely, you can write that off. Okay. Now, the shirt without the logo, just to look nice and pretty for your clients, no, that's not going to work. But something with a logo on it, certainly you can write off. Your cell phone is not 0% business. It's not 100% business. You know your usage better than I. Somewhere between there, you certainly can write that off. Internet's the same way. If you use your internet at home, internet's not a home office expense. You use your internet like you use your cell phone. It's not 0. It's not 100. You know your usage better than I. It's not like electricity in your house, which, heats the whole house, right? Or cools the whole house. That's different. Internet's more specifically used like a cell phone is. But yes, if you have an area in your home where you have a desk and you can take the square footage of that area and divide that into the square footage of your residence and create a percentage, and you can write off a percentage of your rent or mortgage interest, real estate taxes, homeowners, HOA dues, homeowners insurance, renters insurance, utilities, electric, gas, water, security. You can write off, that against your business income as well. Okay. Now you got to be careful with that home office thing. They want you to be exclusive and regular and exclusive. Regular is pretty easy to satisfy that condition. Regular means you go there a lot. Exclusive has two meanings. One is you don't have anywhere else to go. So if you've got a office at your broker's place and it's got your name on it, and that's where you go and do stuff, do everything, well, then maybe an area at home isn't necessarily exclusive because you've got somewhere else to go. The second definition of exclusive is that's all that area is used for. Okay, so clients will tell me, I do all my stuff on the dining room. Well, to get from the kitchen to the bathroom, you got to go through the dining room. It's no longer exclusive. Okay, so it has to be like a corner of the game room or a separate bedroom or something like that that's definable. And if the IRS wanted to come and see it, it would be clear that, this place is regularly and exclusively used as an office, not as a dining room. Okay. Anyway, so those are the types of things that we can write off. People have said, it's a red flag to claim a home office. No, it's not. Most home offices are 5 to 10% of the house. 2,000 square foot house, maybe you have a 200 square foot home office, 150 square foot home office, something like that. It's going to create a deduction that's maybe, $4 or $5 grand. Because again, we're doing a percentage of all those expenses. $4 or $5 grand, and you're in the 20% tax bracket, saves you $1,000. The IRS doesn't chase people down for $1,000. Okay, they're a business like you and me. They want to pop you for 20 grand. They're not going to send somebody out to check all your records just to support a $500 tax benefit. That's kind of silly. Now, for claiming 40% of the house, well, then that's something wholly different. That's a tough thing to say. You exclusively have 40% of your house set aside for business use, right? That's kind of odd. Doesn't happen very often. So claiming a big giant percentage is probably not a good idea. Again, I've seen it though. The one time I've had the IRS want to come out to see a client's home office. This was a long time ago. You can tell by what these guys did. They would fly over to Japan or Taiwan or whatever every year, and they would buy a bunch of CDs, anime CDs, and bring them back and sell them on the internet on eBay for $10 a piece. $350,000 worth. Okay. So they had one bedroom and it was just stacks of CDs. Okay. And then they had another bedroom where they had the rolling thing and boxes and tape. That's where they packaged the stuff that they sold. And then they had a third bedroom where they had a couple of tables like these set up, and he had a computer going and she had a computer going, where they ran the business, right? So it's clearly home office. And we ended up taking like 35% of the house because those 3 bedrooms, and the IRS agent wanted to see it. And I presented pictures. No, I want to come see it. All right. So we met there, not as a surprise. We met there on a Friday at 7 o'clock in the morning and gave her the tour. And the auditor of the tour, and no tax due, no change. It wasn't any big deal, but it was triggered because of the, not everybody has 40% of their house or 35% of their house set aside for home office. That's a little bit outside of the ordinary, right? Again, most home offices are 5 to 10%, which makes sense. But that's the one time that happened. And again, it happened a long time ago. These guys were selling anime CDs on the internet. Okay. How long ago was that? 2007, 10, something like that, a while back. Anyway, who gets audited? Self-employed people get audited. If you have a sole proprietorship, which you guys, many of you may have, particularly if you're doing this kind of part-time or just started, you've got a sole proprietorship, and those are the folks that we see get audited. We prepare a little over 7,000 returns. Okay. Every kind of industry that you could possibly imagine. And I would say we have probably anywhere from 2 to 6 audits a year. Which isn't a very high percentage of the returns we do, but all of those returns are sole proprietorships, Schedule C sole proprietorships. S Corps, I've had one S Corp audit my entire born days, and that was back in 2007. Okay. S Corps don't get audited very much. Now, yes, you can file things that'll get you audited, and they look for crazy things like 35% of your house. Okay. I had a fella who made 62 grand one year and he had $48,000 worth of business meals. And I said, dude, you're going to get audited. He goes, let me show you. And he showed me what he had, and it was gold. I mean, when, who, where, why, how much, what was the business purpose, detailed business purpose. So we filed the tax return. Sure enough, 2 years later, we get a letter from the IRS. Please come down to our offices on Commerce Street in downtown Dallas, and oh, by the way, bring your business meal information. So I walked in there. 45 minutes later, walked out. No tax due, no change. So we had enough information to support it, but that's kind of odd that you would have 48 grand of meals and 62 grand of revenue, right? How'd you eat, right? Well, I guess you ate with the meals, but how'd you pay your rent? The next year the guy made 350 grand. Okay, he was in sales. And he was planting seeds for his business as he was getting it started. And so it's not uncommon that you spend a lot of money up front to plant those seeds with all your clients. Yes, you can make an S Corp election if you have that LLC. And that can help you. We could talk one-on-one on the benefits of that, but you can save a significant amount of money in self-employment taxes. Okay. What are self-employment taxes? Self-employment taxes are the way the IRS collects Social Security and Medicare on self-employed people. So when you have a profit on your sole proprietorship, you're going to pay 15.3% in self-employment taxes. Making the S Corp election, S Corps, the income is not considered earned income, therefore it's not subject to that 15.3%. So yeah, in many cases, we'll make a recommendation that someone who has an LLC to make an S Corp election so we don't have to pay that 15.3%. There's one primary reason I would not make the recommendation, and that is if you're making less than 40 grand in profit, then one of the requirements of having an S Corp is you got to pay yourself wages. So you got to get set up and pay state unemployment taxes. You got to file quarterly with the TWC. You have to file quarterly with the IRS. You have to issue a W-2. So there's a cost and administrative hassle with running payroll. So if you're making less than 40 grand in profit, not gross income, but after expenses, I won't recommend making the S Corp election because all your self-employment tax savings are going to get eaten up by the cost and hassle of having to run payroll. So bottom line is you're not making enough. Okay. But again, we will try and do that for folks because you can imagine if you've got $100,000 profit as a sole proprietorship, you're going to pay income taxes on 100 grand plus around 15,000 in self-employment tax. If you were an S Corp, that 100 grand, we'd pay you wages of 30 grand. We typically target 30% of expected profit. And you'll pay Social Security and Medicare tax on 30 grand, which is only 4,500 instead of 15,000. That's the game. Okay. But anyway, that is something that we can speak about offline. We do that with many of our clients, make that conversion, help them with setting up the payroll, determining how much reasonable compensation needs to be, and people can save a lot of money. We have a program where you can hire your kids if you have minor children. Hire your kids and pay them a wage. There's part of the Internal Revenue Code that says if mom or dad or mom and dad have an unincorporated entity, okay, that can be an LLC that's not an S Corp. S Corp's a corporation. You can pay your minor children a wage and you don't have to pay Social Security or Medicare tax on the wages. Okay, it was set up, became part of the Internal Revenue Code back in the 50s and 60s to help the family farm. It also helps the family restaurant or realtor or CPA firm or whatever, right? So we created our Optima program, and we pay each kid $8,400 a year, and age appropriate. We go down to 6 years old. A 6-year-old can clean the home office and shred paper. Teenagers can bake cookies and help with staging on or wash dishes at the restaurant or whatever. We have a fringe benefit, a medical expense reimbursement plan that's part of the employment agreement that says mom or dad's company is very generous to its full and part-time employees and will reimburse all out-of-pocket medical expenses. So it's a way to make all deductibles, co-pays, glasses, contacts, braces, anything not covered by insurance or paid for through an FSA or an HSA, 100% deductible as an employee benefit for mom or dad's company. So it's a great way to keep wealth within the family. My son went to Jesuit. Guess who paid $8,000 for his own tuition? Okay, he did. Before he was at Jesuit, my air conditioning broke. Guess who paid for it? He did. It's perfectly legal for a child to contribute to household income. Some of my clients will use that money to pay for tuba lessons or Spanish lessons or baseball fees or cheerleading camp or vacation Bible school. I mean, all those millions of things that kids cost us. It's kind of a good way to get that stuff deducted, right? Kind of through the wages. Okay. Anyway, so that's one thing that we can do with folks who have kiddos who are minors, the 17 and younger, down to 6 again. There's something else you can do is something called the Augusta rule. Okay. The Augusta rule says that you can rent your residence out for less than 15 days a year and you don't have to pay tax on the income. And it's called the Augusta rule because the folks that live on the fairway at the Masters Golf Tournament, they rent their house out to Tiger Woods for 14 days. They don't have to pay tax on the income. Okay, so let's say I have a little CPA firm here in Frisco, and I office about 3 blocks away. I live about 3 blocks away from my office, and I want to have 12 monthly meetings and 2 semi-annual budget meetings. Okay, 14. I don't want to do it at my office. There's too much going on. I reached out to the Stonebriar Westin, which is down the road a bit. Said how much to rent a small business meeting room for less than 10 people with coffee service and continental breakfast. They said $1,000. Great. Can you send me that in an email? So now I have fair market value of a business venue in my neighborhood. Well, I'm not going to do it there. I'm going to do it at my house. So my S Corp pays me 1,000 times 14. I just created a $14,000 deduction out of thin air. Okay. State of Texas says my wife owns half my business, whether I like it or not. We talk about it all the time. So once a month, I get on Word on August the 7th. The meeting began at 9 a.m. We talked about July's financial results and what new clients I picked up and where I'm going to network and what color we're going to paint the walls. All those conversations she and I have on a monthly basis, I document on a 1 to 2 page minutes document. It's less than 15. I have a provable market rate, and I have minutes to support the meetings. It's a slam dunk, and I just saved myself $2,000 to $3,000. Okay. Can't do that with a sole proprietorship, but you can do it with an S Corp based on the research that we've done. So anyway, those are kind of some of the things that we've come up with to help people keep more of their money in their own pocket. Hard for you to say, right? My whole philosophy is I hate the IRS because I see what they do to people, but they're like a 3-year-old that throws temper tantrums. You don't want to get them mad or upset. Okay. They don't send me a thank you note or a Starbucks gift card or a gold star when my client pays taxes. So I gain nothing from you paying taxes. So my first job is to minimize that number. My second job is to make sure I'm not taking a position I can't reasonably defend in an audit. I'm not going to take a position that I know won't fly with the bad guys, but if there's If there's a way I feel comfortable with it, if you give me all your business meals and they're 48 grand and you had 62 grand in revenue, and I'm comfortable with what you provided with me, that I can come and fight the battle in case they want to fight one, then heck yeah, I'm going to take it. It's in the book. It says we can take the deduction, so even if it's a red flag deduction, I'm going to take it if I'm comfortable with it. And I want to take it. Why do I want you to pay taxes? I don't want you to pay taxes. I don't want to pay taxes. You and I spend our money much more efficiently than the government does, I think. But so we want to keep as much as we can in our pocket, but we also don't want to get in trouble, get on their radar screen where we have taken a position we can't defend in case they want to get curious about it.
Good question.
Yeah.
Your staff has grown a lot in the past few years.
Mm-hmm.
Do you personally review each return? How does it
The way it works is we have a preparer that prepares them. And again, depending on the complexity of it, if you've got a little old lady return W-2, maybe some pension income or something like that, one of my more junior people are going to be able to do those. And then they prepare it, and then an experienced person, me or one of my other more experienced folks, professionals, review all the returns. You got to have two sets of eyes. When you're doing something as detail oriented as this with numbers, it's so easy to transpose and yada yada. So we always have to have that second set of eyes. So do I see most of them? No, I don't. Or yeah, do I see all of them? No, I don't. But I see most. Particularly the more complicated ones. But we have other people who are trained, and Pam Allen, she's kind of my Robin to my Batman. She's a CPA with 25 plus years experience as a CPA, been with me since 2014. She is me. So she knows everything I know. And then we have a couple of other young ladies who are 5-year CPAs, 8-year CPAs. And then I've got about 6 kids who have passed various parts of the CPA exam, who are more experienced, and we're starting to get them to review returns as well, to help manage, increase our capacity in that regard. Because it's tough doing 80, 100-hour weeks for 2.5 months for 25 years. So yeah, I am slowing down a little bit, but I'm not going away. How's that? Anyway, the OB3, the one big beautiful bill. The biggest thing that it did that a lot of people aren't going to see necessarily, and that is all the things like the lower tax brackets, the more favorable tax brackets and things like that, the QBI deduction, the qualified business income deduction that us self-employed people get, those kinds of things were all set to expire on December 31st in 2025. Okay. Well, one big beautiful bill said, no, we're not going to let that stuff expire. So it's still, those things are still in play. Okay. Just those alone saves the average taxpayer $1,800 a year. So, it's the more favorable brackets and what have you can really, really help a family on 50 grand. Let's make it 50, 60 grand a year, something like that. It really can help them a lot. So they made those permanent now, so they're not going to expire. And that's the biggest impact of all to all of our tax returns is it's not going back to the way it was back in 2017 when the rates were higher and the QBI deduction didn't exist and yada, yada, yada. It was a much more mean way to collect taxes, in my opinion. But some of the other additional things that they've done, there is no tax on tips and no tax on overtime pay. Y'all and us, we're not in the business that gets tips. They have specific industries, the hair salon, tattoo artist, doorman, people like that, housekeepers, things like that. Those professions are, it's pretty standard and common for, restaurant servers, pretty standard and common for them to get tips. Okay. So I can't all of a sudden say, oh, I'm a CPA and I'm going to charge you, $500 to do your tax return, and 450 of that is a tip, and 550 is for the return. I can't do that because my industry doesn't necessarily do that. Okay, same with you guys. Realtors aren't typically earning their income via tips, but a lot of people are, and it's going to provide a nice benefit for some people that they don't have to recognize income. I think the amounts are. I don't have all the thresholds memorized just yet. I know I will. But I have to use a cheat sheet. But let's see, it phases out the tip and overtime exclusions both phase out at $300,000 joint income. They start phasing out for a married couple, 150 grand for a single person. And you can set aside what, 20 grand or something like that. Yeah, something like 15, 20 grand tip or overtime income. Overtime's a little bit different. Again, it has to be overtime that's, that you've worked over 40 hours in the week. It's a federal labor, FLSB, Federal Labor Standard or Fair Labor Standard Board rules about overtime where you're supposed to see time and a half. The whole overtime amount is not excluded from income, just the premium. So if you're getting time and a half, the half is what's not taxed. Okay. So if you make typically $20 an hour and you work overtime, it's going to be $30 an hour, time and a half. That extra $10 is not taxed, not the whole $30. See what I mean? So you've got to produce that. And the IRS, in their infinite wisdom, decided not to create a mechanism that would make all that information easily reportable to both taxpayers and or their preparers. And their recommendation is that people make their best efforts to report it right. That's the IRS for you. So there's nothing on your W-2 that shows you got overtime. Actually, there is for tips in some industries, but there's nothing on the W-2. So clients are going to be bringing us information, their W-2s, and did you work any overtime? Yeah, I did. Great. How much? Well, I don't know. How am I supposed to know? I sure don't know. Go get your stub, your last stub. Well, I threw that away. It's going to be a mess. It really is. But it's kind of what we're dealing with, right?
Joe, I have a question for you.
Yeah.
Regarding the one big beautiful bill. I believe also for this year, we can deduct the interest on.
I'm getting there.
On cars that is made in the United States. Right?
I'm getting there. Yeah.
Okay.
Yeah. I just wanted to talk about tips and overtime first. Okay. One that will affect us, and that is the expansion of the SALT deduction. SALT meaning state and local taxes. Now, it used to be the max SALT deduction you could include as an itemized deduction was 10 grand. So if your real estate taxes were 12 grand, you could only write off 10. If your real estate taxes were 80 grand, you could only write off 10. Okay. They bumped that to 40. So that's going to help a lot of people. And the income thresholds are pretty high. The SALT deduction goes away for a married joint couple at 500 grand, starts to go away at 500 grand. So it's a pretty high threshold. Single person, 250. So you'll be able now to include as an itemized deduction, not 10 grand of your real estate taxes, but up to 40 grand, which is going to help a lot of people, whole lot of people. Okay. Cause that's when we do tax returns, Texas notoriously has kind of high real estate tax rates, right? Well, now we're going to be able to use more of that to help lower our income. So I think that's going to be very helpful. And then another one is there's a extra senior deduction. Okay. If you make 6 grand, you can exclude from income 6 grand of income if you're a senior, 65 or older, I think is the threshold. And there is an income phase out on that too. If you're single, it's 175 grand. If you're married, it's 250. So if you're making less than 250, you and your spouse can write off up to 6 grand each, 12 grand total, and not pay taxes on it. Okay. Part of the word was before all this passed was, no tax on Social Security. Well, they couldn't do that because of the way the laws are written. It has to be taxed some. So they said, well, okay, let's give everybody a $6,000 deduction then. So, and again, the income thresholds are not hugely high, but they're pretty high, 250 on a married couple, 175 for somebody single.
So if you're over 250, you're not getting any of this.
If you make more than 250 and you're married, you do not get a $12,000 senior deduction.
Okay.
Okay. Or do you get one if you're 45? You got to be an old guy like me. Before
What
you
the hell, does he think we were just born,
Thanks, you're 45.
Yeah, I thought,
I'm older than you.
That was a compliment.
I got it.
because you're 46 or so.
Oh, honey.
Did I just give him the client? Anyway, but that'll help a lot of folks too. And it's not just Social Security income, it's any income you have that can be reduced by that $6,000 per person. Senior deduction, if you want to call it that. Those three things that I mentioned, the overtime tips, the SALT, and the senior thing, they expire in 2028. So 1/1/2029, right under current law. Under current law, they do have a sunset. Yeah.
You're gonna get Trump elected again in 20.
That's not good to help me. I turned 65, 28. Can we do retroactive?
Need to tell your congressman to make those laws permanent. Make those laws permanent. But that's what's kind of going on there. Those are the things that are really impacting folks. Yes, there also is a deduction that you can take for a new vehicle, not new to you, but a new manufactured vehicle that was assembled in the United States. And you can write off any interest that you pay on that loan, a car loan. The rules are there's an income threshold. I can't remember what it is. I have to look at it elsewhere. I think it's 250 or so. And it's any amount. It's the full interest that you can write off if you're below the income threshold on the vehicle. It has to be U.S. made. You got to provide your VIN number, and one of the little numbers on the VIN tells you if it was U.S. made or not. And again, it has to be a new vehicle assembled in the United States. It kind of gets tricky when you're talking about like a Honda. I mean, some Hondas are assembled in the U.S. and some are assembled in
It can be like a Toyota as long as it's
assembled in the United
here
States.
in the
It'll tell you that. And again,
Right, that's.
I think the
interesting.
number is like the first, second, or third number in the VIN number. 5, 4, and 1 are U.S. assembled. I don't know.
Yeah, interesting. I
they-
did not know that.
I've read it, but I don't remember. But your VIN number will tell you. But you got to provide them with the VIN number and what have you, and you can write off interest. And that's a deduction for adjusted gross income. So it's not an itemized deduction. So you get that flat off the top, which is kind of nice. Yeah.
Now, does that expire?
Huh?
Will that expire in 2028?
I believe it is. Yeah.
I just don't like these good laws expiring.
Well, then you know what the key is here. No,
Get the Republicans back in power.
get the public, vote for Trump.
My birth certificate.
Well, they know how old you are.
Yeah. Oh, believe me,
Yeah, you don't have to worry about that.
they're listening. Alexa is listening.
You're fibbing about that.
Damn phones.
See, I have a question for you, Joe.
Yeah.
Okay, so, y'all know that you got your 1099s sent to you for last year. Anyone that made over $600.
Mhm.
Okay, so you should already have them in your email, but I'm not sure it's not from Hockaday. It's from some other company. What
Tax
company?
1099.
Oh, that's it. Tax the intent. Yeah.
Tax what?
Tax 1099.
Yeah, we have a process that does
Yeah.
that for us.
Okay.
You're required now to file those electronically, and so we got to do that through a
So you all
process.
should have it in your emails. It's called tax.
1099.
Yeah.
It's from them.
Okay.
The interest phase out starts at 100 grand for single and 200 grand for married couples. The interest on your vehicle, and the max you can do in a year is 10 grand.
Joe, the difference between like single and head of household is if you have children under the age of 18.
Mhm.
And they grow up, you can't do that anymore, but you still head of your own household.
So you can talk to your congressman about changing that definition.
No.
I just know the rules.
Well, what if they still live with you, but they're over 18?
Well, if they're over 18 and they live with you and they're dependents, you're still head of household. You are.
I'm still what?
You're head of household.
If they're over 18?
Here's the rule.
And they're
18,
dependents.
here's the rule. 18 or younger, they're a dependent. Doesn't matter. 19 to 23, if they went to college for 5 or more months, they're a dependent. If they didn't go to college and they had earned income less than $5,000, then they're a dependent.
But if they're over 23,
And then over 23, if he has income less than $5,000, then he's a dependent. That's how you can write off grandma, grandpa if they live in your house and you cover over half their living expenses. Grandma, grandpa, you can use them as a dependent as long as they didn't have earned income over $5,000
if they live with you for a certain amount of time.
over half the year.
So if they have to live with me more than 6 months and make less than 5,000.
For them to be considered dependent, yes. And of course, they can't claim themselves if they file a return. So there's that.
It's okay. It's, I'm working it.
Right,
I'm reading your about me.
right.
Oh my gosh.
But yeah, the interest deduction has a pretty low income threshold. It starts to go away. 100,000 single, 200,000 for married couple.
Because it's a huge difference between the percentage you pay as a head of household and a single.
It's more favorable, yes, than single. Absolutely, it is. It's more favorable. Married joint's even more favorable.
But that's more difficult to find a husband than someone who's. For 6 months.
I don't know this whole birthing process to me seems to say that the head of household's a lot harder.
I just have to think about this.
But anyway, yes, there are some things that they put into the law that are going to save people money. And, it's going to be very, very helpful. There are also things related to the child tax credit that have gone up a little bit. But yeah, the numbers I'm seeing are like $2,500 per taxpayer on average is going to get a better situation. And we haven't done enough returns yet to get kind of a flavor for, refunds are up this year, or people aren't owe as much, or stuff like that. I can't tell you that necessarily. I've only reviewed probably about a dozen returns, and nothing sticks in my mind from a trend standpoint as to what's going on. But it certainly will. And my anticipation is it'll be better for everybody.
What about, isn't he sending some kind of money back to everybody from tariffs or something? Is that going to be,
Nothing passed the law. There's not been a law yet. Nothing's passed.
we're working on that?
Yeah, I think so. Who the hell knows? They say all sorts of crazy stuff, and I'm like, oh no, don't do that. Don't do that. This whole overtime thing,
Great.
it's like,
Appreciate it.
make your best efforts. Oh my gosh, what a mess. Yes.
One of the other times you were here, you mentioned something like someone doesn't pay their quarterly taxes at the end, the penalty was less than something, like, do you remember that?
We have a pay-as-you-go system in the United States.
Yeah.
Okay, meaning that the IRS, as you earn money during the year, they want you to pay it, right? So if you're a W-2 person and you get your paycheck from your employer, they take out taxes, right? And then within a day or two, your employer sends that money off to the IRS. You pay as you go. If you have untaxed income, okay, so that could be self-employment income, or maybe you sold a rental property, or you have a rental property that's profitable, or you have a lot of dividends or interest income, something like that. Untaxed income that's coming in that people aren't taking taxes out. The IRS created a quarterly voucher system, and they want you to send in money April 15th, June 15th, September 15th, and January 15th of the following year in order to, quote, pay as you go when you have income that's not been taxed. Okay, taxes are taken out. If you don't pay as you go, if you don't make those quarterly payments on your untaxed income, you may be subject to the underpayment penalty. Okay, what's that? That's the lesser of 110% of last year's taxes or 90% of this year's taxes. Okay, whichever one's less. So for example, if on your tax return, total taxes, say 10 grand, 110%, that's 11 grand. And tomorrow you win the lottery and you win $1 billion. As long as you send them 11 grand, you'll have no underpayment penalty. Okay, you'll have a big fat check to write on April 15th, but if you send them any more than 11 grand, you're just giving the government a 0% interest loan. That's kind of silly. If you win $1 billion, you're going to owe about 300 million. Stick the 300 million into a CD that matures on March 31st, so you can write a check to them on April 15th. Earn a little bit extra grocery money. So, but anyway, that's the requirement to quote pay as you go, the lesser of those two numbers. Okay. Now the penalty itself is calculated right now at 7% APR. So don't go put your tax bill on a 28% credit card. Okay? I've had clients do that. Instead, get on a payment plan with the IRS or whatever, 7%. It's a heck of a lot less expensive for an unsecured loan. That's not so bad, right? So it's much better, in my opinion, financially sound to not put it on the credit card and pay 28% interest. It's better to set up a payment plan with the IRS. Same thing goes with the underpayment penalty. So again, it's only 7% APR. We're not talking some giant, huge penalty. Yeah.
So it is better to pay the quarterlies or not?
Depends if you want to avoid the 7% underpayment penalty. Yeah. And it depends on how much, again, it depends on last year's total taxes and this year's total taxes.
That's too much math. I'll just pay them.
So 7% per annum.
Yes, APR.
It's a one-time deal then.
Well, again, if you're underpayment penalty, if you should have sent them $1,000 and you didn't, 7% of $1,000 is $70. So it's APR on that. So it's probably about $40, maybe $50 on $1,000.
So if you have,
Nickels and dimes.
for years, if you have paid quarterlies and then you go, okay, the light has now gone on. I want to be able to save that and I'll pay that 7% or whatever it is. Does the IRS all of a sudden, does that flag something that now I have?
You'd probably go to jail.
Oh, nice.
No,
But it's
it
federal.
doesn't flag anything other than the fact that you might have to send them a little extra money because you have an underpayment penalty.
Okay.
You're not going to go to jail. It doesn't mean, oh, come here, Charlie, look at this one. Let's go audit her. She's doing it different than she did the last 5 years. No, they're not going to do that. Not in that circumstance. Now, I will tell you, they're business, right?
Oh, yeah.
So if they audit you and they yank 15 grand out of you, so they drill a well and they 15 grand of oil, they're going to drill next year.
Well, but oftentimes
They're going to drill until they hit a dry hole.
but does an audit kind of get flagged all of a sudden if you've been doing this for so many years and then all of a sudden
that.
you start making, some slight changes all of a sudden, and I'm wondering why she's doing that or they're doing that or whatever. Yeah. Okay.
Not necessarily. It really kind of depends on the change. I mean, if your change is you've been doing a home office and it's 7% of your house, and all of a sudden you say it's 47%. Well, yeah, that's a big change. Kind of ought to be changed.
Yeah.
Depending on what your tax bracket is. But
Or if your income is 100,000 and you needed that particular next year to dissolve some of your stocks, and all of a sudden your income is 250, unless you have the documentation that show that you liquidated all these assets and this is how much you generated, absolutely it would be a red flag.
well, but the IRS gets a copy of that piece of paper also.
Yeah.
So if you don't report something that they got a copy of, oh, dude, you're going to
Because upon the sale of those dissolved stocks, they're informed immediately, right?
Any of those IRS forms that you get are also being sent to the IRS.
Yeah.
So your W-2, your 1099. Oh, it's one thing I want to mention about 1099s. For 2026, that $600 threshold goes to 2,000.
Wow.
So if you
Wow.
pay someone $1,500 to provide you with business services, a contractor, and you pay $1,500, you don't send them a 1099. Okay,
Wow.
it's less than 2,000. So the 600 is bumped up to 2,000. Again, that's for the 2026 tax year, not 25.
Okay.
Any other questions? Yes, we are accepting new clients. We're very busy. I know my calendar and any of the other folks who meet with clients, their calendars are busy. We're full. We do have a portal where you can upload documents, and there's an organizer in the portal that can help you gather your information to upload. Call me on my cell. You gotta get my card, I'll answer it and I'll respond to it as quickly as possible. Right now, people are like, oh, I just want to talk 15 minutes. That's fine. Okay, call me. If I can answer, I will. If not, leave a message. And then if a previously scheduled meeting cancels or runs short, then I'll call you back. And, that's kind of how that thing goes. And just being here right now.
I'll just say, we've been dealing with Hockaday CPA, at least I have, for over 20 years, probably 30.
Right after you learn how to drive, right?
Right. Taught me how to drive.
What?
But, and he does a lot of independent contracts, a lot of real estate people, so he's gonna save you some money if you just use a regular CPA. They don't understand our industry. And there's a lot of clients, but.
Yeah, I don't want to put out there that we're not accepting new clients, because, people leave, they no longer are self-employed, they take a W-2 job, or they pass away, or they move away and might want to have their guy, they move to Louisville and they want to have their guy close by, they can go see him. I get that totally. I mean, we have clients all over the country, all over the world, actually. We can handle people that don't live here, but if you want, if people leave, so we don't want to totally put out there to the marketplace saying we're not looking for new clients at all. A lot in my profession are. There's a big problem in my industry. There aren't enough of us. Okay. There's a 20% increase in the number of accounting jobs nationwide every year. There's a 17% decrease in the number of accounting graduates. There's 500 or 300,000 CPAs retired last year. There's a real problem. All those kids are going into finance, or most of them are going into IT. It used to be, it's starting to change, but it used to be, well, when I sat for the CPA exam, I just had to have my undergrad. Okay. I did get my master's later, but I was already a CPA when I got it. A few years after I got my certification, they said, no, you got to have a master's to sit for the CPA exam. So that's another year to a school, another year to a tuition. This guy's thinking, okay, do I go accounting, or I got to go for another year and get a bigger student loan, or do I go IT like my buddy here who's just got out of college? He's making 75, 80 grand a year, and he's working right now, and I got to go to school again. I'm going to go do that. And so a lot of those quant guys are going into that or finance and not coming into accounting. However, the state of Texas is one, and other states are following. State boards of public accounting, Texas State Board of Public Accounting, they got rid of the master's requirement. So now you can sit for the exam if you have 120 hours, which is undergrad level. They did that a couple of years ago so that they can make the club a little less exclusive, if you will, so that it would attract more people, right? But yeah, it's crazy. There just aren't enough of us at all. I mean, 18 months ago, I was seeing anywhere from 2 to 7 people a day. Pam was seeing the same. Now I don't see any more than 2 or 3. We have other people that are seeing new clients. Pam's not seeing any more at all, but we've toned it down, make sure we can handle everybody. It's really, it's been a factor. I would say 70, 80% of those people that we were seeing back then, 18 months ago, even now, are coming to us because their guy retired, or in some cases passed away. And so it's a real big problem. Now, I know it's hard to believe, but I'm not 37. So in my office is my son, James. I think he came and spoke here with us before, maybe even did it for me before here. And he got his undergrad at OU and his master's at UTD. And he went to work at RSM for a little over a year, which is the 5th largest accounting firm in the world. And I twisted his arm and he came and joined us about 3 or 4 years ago. And so hopefully if I decide this isn't fun, we won't go away. He'll be there and we won't tell you, sorry, I'm going to retire, or I sold my business to these shysters, But hopefully that doesn't happen. I don't think it will.
I hope not. Well, thank
Okay,
you.
we thank you, sir.
Anything else, kids?
Let's get it.
Well, thank you all very, very much. I appreciate it. I come here, once a year, twice a year?
Once a year now.
Yeah.
Yeah, February, we'll schedule you after this meeting, then I'll send an email and we'll book you for next February.
You can go.
Yeah.
I'll be in, ma'am.
Thanks.
All right, guys.
We're not done yet. Mal and Ashley is going next and then Mal.
Okay.
Hold on, I just want to, hi.
Hi, yes, well, I'm Anitra.
Okay.
It's been a while. I Zoom called with y'all a little while back. I was gonna email this like, it's now I wrote them out. Is it you? I am coming to the field to see.
Okay, okay, that's why I wanted to get her introduction before we get started.
Yeah.
So Val, do you want to go first or do you want me to go first?
You go ahead.
Okay, so we have two guests now that are coming to see us, Anitra and Ricky. They are just kind of in the wings and just kind of seeing if we're a good fit for their, their brokerage. Hopefully we are. You guys can call me or text me if you guys need anything. Ricky had made a comment. If anybody is willing to let him shadow while he is in the wings, I'm sure you would appreciate this too. Take his number, get the opportunity to meet with him a little bit. He's a great guy. And he would love the opportunity to do some shadowing. He's in his prep courses. You've already passed your test, correct?
Yes.
Okay. So you're just kind of in the wings, just doing some interviewing. Perfect. Don't forget, friends, that we have our referral rewards program. So if you guys have anybody that wants to join us, then you can send, you don't want to not hear about the money part, Amy, come on. So if you guys have anybody that wants to join us, they get $100 right off the bat once they join us officially. And then if they make a sale within the first 6 months, they'll receive an additional $500. So I appreciate you for helping me out on the recruiting side of things. Having some friends come and join us. We love more friends here at Competitive Edge. So if you're working with anybody, know anybody out there in the field, send them my way. I'm not pushy. I'm not going to, force them to join us or anything like that. Just looking for the opportunity to get to chat with them, know them, and tell them about our family here at Competitive Edge. So that's kind of it. Thank you for coming. And thank you, Ricky, for joining us.
Yeah. Okay, so the other day, someone told me that I think I missed one of our sessions about the negative market. So you hear people talk about the market is down and doom and gloom stuff that you hear from other people. And I hate that. I'm not a doom and gloomer. I'm a very optimistic person. When I started in real estate in 1985, the interest rates were 17%. The market was unbelievable. I mean, every other house was for sale. There were foreclosures all over the place. And I remember walking into my first office and a girl was walking out and I said, "Where are you going?" She says, "I'm leaving. I'm getting out of the business." I said, "Why?" She says, "There's no business." And I said, "Great. I just spent $2,000 or whatever it is to get my license and all this time. And I've made a big mistake." So I didn't follow her. I stayed with it. And it turned out to be a fantastic career. And you just have to move with the market. So at that time, it was foreclosures. We're not in a foreclosure market, but I learned everything I could about foreclosures, and I started calling on banks and started getting properties that were in distress and short sales and all of that. And I boomed. I was rookie of the year in the company. But you have to be able to move with the market. And so that's the first thing I want to do is don't get around negative people. When you hear something negative, just say, "Don't want to hear it. Doesn't have any effect on me." And when people talk about the market in the paper and on TV, they're talking about the national market. They're talking about the United States of America. They're not talking about DFW. They're not talking about Austin. They're not talking about Houston. This is the golden triangle of the United States is our market. We have more people moving into this market than any other market in the United States. There's going to be no reason for anyone to complain about business. It's there. You just got to figure out how to get to it. And that's our challenge. So
You're right.
thank you. Hey,
All right. I mean, we do a lot of real estate folks. Yeah, some are worse. Some are have not done as well here the last year or two. But there's a lot of business still out there. We are in the bubble. It's weird.
yeah, it's crazy. So one of the things that thank you for that.
Thanks.
I love to have somebody credit instead of just. Anyway, one of the things that I used to be pretty active in our leadership with our board, and when I was president-elect, was in 2010. There's an economic forecaster for NAR. His name is Lawrence Loon, And he's unbelievable. And he said back in 2010 that we're going to see a turnaround in the market because it was the pits. And we're all sitting there saying, he's crazy. There's no way. And I mean, he hit that thing right on the money. So I've always had a lot of respect for this guy. And last week they had a broker power hour and he was the featured speaker. And so I took pictures of all the graphs he put up there. But first of all, that this is nationwide also. And that's the good news about this whole report is that he's not talking about us. He's talking about the entire United States. So you probably could double the numbers that he's talking about. But existing home sales down, all during 23 and 24 and 25. But then if you can see this little circle here in December, it shot up. Okay, so this is nationwide. We had an uptick, the first big uptick for the last 2 years. He said, now that could be just a fluke, it could just be something happened, or it could be the beginning of a new trend. He thinks it's a new trend. Luxury homes. Here's a chart. I don't know if you can see that, but it's all going up, especially in the last couple of years. Inventory. Now they're talking about inventory being down nationwide, but what is it around here? High. See, so it's almost the opposite of what nationwide. So and what does that mean to us? That means more properties on the market, prices will be down. Real estate goes down, right, with more inventory, and buyers will have more room to negotiate. So it's a good thing. I mean, we'd like to have it not go way down to where you got millions of properties and no buyers, but we've got buyers. So that should be a good thing for us. Some of the proposals that are on the thing is the capital gains. Oh, you all heard about this, but right now a single person sells a house, it's $250 tax free. So if they bought a house for $100 and they sold it for $350, that gain, there's no tax on it if they lived there more than 2 years. And if you're married, it's $500,000. Well, when COVID hit, we were seeing people prices went out the window, and people don't want to sell their house because they have to pay a bunch of capital gains. Well, now they're talking about doubling that. So instead of being $250 for a single, it's going to be $500, and instead of being for married $500, it's going to be $1 million. So that's going to give sellers more reason to sell and buy something else. So that's a positive thing. I think the biggest thing that he said was he's projecting 14% increase in our business in sales for the United States. 14% uptick for this year. Now, for 26. 14% is what this is a guy that studies this stuff day in, and he works for our industry. And then he said, the next year, another 14%. So we're in a if he's even close to right nationwide, that number could be 20, 30% in our market. So I was very optimistic. And that's why I say people that make projections in the paper, they don't do what he's doing. And he's studying trends, income levels, inventory levels. It's amazing what he does. So I just want to let you know that we're in a great market, and don't be around negative people. If you start hearing it, just walk away and, talk to somebody that this is what you want to get data to back up what they're saying. So it's my pitch. It's Lawrence Noon. I think it is. It's Loom or YUM.
And one of the things, just to kind of piggyback off what Mal was saying, is I actually just posted on our social media the January trends. I don't know if you saw that. So it's already out on our social media, the market trends from January. And based on even just looking at that, our inventory levels have dropped. I put out, I think there's like 10 different cities that I did a market analysis on. And so it shows the homes that are on market, the median price, median days on market, all that kind of stuff. So you can see each one of those cities. You just look at the top and it says January 2026, and it has the city below that. So I went from like Cedar Hill, Dallas, Carrollton, there's Frisco, the Colony, Little Elm, Denton, and there's a few others. So check that out. And again, trend, I mean, and that's information that you have access to because you can log into the MLS and look at trends and pull up a city if you want to. But looking at our inventory levels of what they were back September, October, November, when we were kind of close to 4.5 to 5 months of inventory, and some cities were even higher than that. To see, and I don't remember which one just because I just put it out there, but one of the cities is actually down to 3 months of inventory.
McKinney is
And-
down to 2.
Yeah, so I mean, all that to say is, I mean, you know, with the inventory levels, properties that have been on the market for quite some time, we're getting more views, we're getting under contract. Maureen and I, we have 2 listings that just over the weekend, I mean, properties that have been on the market for several months, and then all of a sudden offers are coming in, and we have, you know, 2 that have gone under contract just in the last 48 hours. So don't be discouraged. Like Mal said, you know, don't listen to all the negativity because we're in the trenches, we're here, and we're seeing what's really happening. And you know, if you stick with it, then it's still a lucrative business to be in. And you know, it's those of us that stick around the way that we are that kind of ride that wave. So.
And also, you know, the administration, whether you're a Republican or Democrat or whatever, this is a business oriented administration that we're in. They're very business minded. You can, every time you turn on TV, you'll see he's having meetings with oil people and, you know, minerals and, you know, he's a very business oriented administration, and housing has become one of their top priorities. If you've been following anything about it, you know, he's talking about new directions. He's talking about 50-year mortgages. Oh, who ever heard of a 50-year mortgage? I mean, it may not be anything, but they're trying to figure out a way to stimulate housing. Lowering interest rates. I mean, he's been pushing to get the interest rates down. He's going to fire the Fed chief. I mean, he's, you know, it's crazy in a lot of ways, but he's trying to create a more positive real estate industry in the United States. And, you know, he's going to have some successes with it, and it's going to be to our benefit. So I feel like the pressure on the interest rates is going to continue. It may not be big right now, but over a period of time, we're going to see it's already come down since the new administration. And I think we'll see more trends going that way. So just keep positive. Okay.
Thank you, sir.
All right. Any questions?
Any questions,
questions?
concerns, emotional outbursts?
Disturbances?
So that will conclude today's meeting. But for those that would like to stick around, I know y'all just love my videos. But if you want to stick around for, you know, a quick